Hey, good afternoon, everyone. Thanks for coming. Thanks for giving me your time this afternoon. This is Mark from Right Line Trading. A little under the weather today. I got into the live trading room late, and just hang on one second here. But I'd like to show you a really powerful system that I'm telling you we're gonna move to a live chart after I finish the slides, and you're gonna see that we're going to be very challenged to find a loser, and they're so few and far between. It's really pretty amazing. Now, a lot of you may have seen some of this presentation, so it'll be a little bit redundant, but I think it's still worth going over. Let me just go to this disclaimer. It's the mandatory disclaimer. That all signals and trading opportunities provided both orally written or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Our Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures of Forex markets, nor for any profits or losses that may be incurred. Participating in trading in the Forex and futures markets does involve substantial risk. It should be understood that a person can lose substantial amounts of money. Therefore, the participation in these markets is not appropriate for everyone. Careful consideration of your financial position should be made prior to trading. We are not, here at Right Line, we are not licensed commodity trading advisors, and you may want to consult one before taking a trade. So with that said, let's just move forward. I'm going to skip the little bio I have about myself. And what we're going to do is we're going to go right to the system. Now, I just want to talk briefly about the kind of candles we use. Now, I'm going to show you Renko candles. And again, if you've seen this slide before, you know why I like Renko candles. But I think that the way that price movement is described is very important. Is a very important component of trading. You can use time, you can use tick, you can use Renko, you can use range. Now all of them are okay, and traders can be profitable on any of the different types of candles. And for a long time I used range. And the reason I liked range was that each candle is formed, or price is described based solely on price movement. It's not cut off by any given unit of time or any given unit number of ticks. So the only thing that defines this is volatility. And I really think that this creates a really advantageous way of looking at price movement and market structure. But based on the way that the markets have been moving in the last year or two, I think that Renko does a much better job. Now, Renko has to the settings have to be individually optimized, not only for each market, but for each instrument within each market, based on the volatility of what you're trading. You can't have the same Renko size for Amazon as you do for like advanced micro devices, or the same size for the NASDAQ as you do for the E-mini. So you have to individually optimize each input. But what it does is give you the ability to see great symmetry and allow you to capture very big trends. I could really spend an hour talking to you about Renko candles alone, because they're really incredibly. They're very clever ways of tracing out price. I really like what they show. Now, the positives is that they obliterate price action. They don't really give you the full ability to tell you who's in control of the market, bulls or bears, based on Japanese candlestick patterns. You can't see an engulfing candle, a dark cloud cover, a piercing candle, a doji. You can discern rising and falling triangles and channels, but not nearly as well as you can, say, with range candles or time or tick. So you do lose something. But this is if this is your first time hearing me talk about this, it's important for you to know that Japanese candlestick patterns have really lost a lot of their power. Now, I know there are a lot of companies that just trade these and proffer these, but I'll tell you, if they did, they've never made anybody profitable just trading price action. But in today's market, they're just not nearly powerful enough. And the reason is because the market is now dominated by institutional volume. I mean, on crude oil, it may comprise up to 60 to 80% of all volume in a given day. And what institutional traders do is they just run these patterns over. Now, when the Japanese created these, the Japanese rice traders created these patterns 400 years ago, they based them on the assumption that the power of every buyer equaled the power of every seller. And when all there were just simply commercial traders in the market, that was true. And even back as far as 1955, 1957, when the next indicator that I'm going to show you, the oscillator, was created, that was also true. The power of the bears, the power of each individual buyer pretty much equaled the power of each individual seller. But that's just not true anymore. And although it's nice to know Japanese candlestick patterns, and there are certain patterns that are very powerful, these are definitely weaker patterns than they have ever been. And as we move out into the future, they're just going to get weaker and weaker for day trading and swing trading. And you see a lot of charts based on these, but nobody really ever looks at the predictive power of the chart. I mean, how great is a doji for calling a bottom or a top? And I see that especially in a lot of services that look at trading options. They'll call a bottom based on a bottoming formation, based on Japanese candlestick patterns, and very often they fail. Now, the strengths are they filter out noise, and that noise causes appreciable problems because visually it may be very, very difficult to determine when there's a trend and when you're in chop. So by filtering out all the noise, it really helps us trade. The only thing that you have to have are powerful leading indicators, because in filtering out noise, it's much easier to get into a trade in chop. So every time you give something up, every time you gain something, you give something up. It's always a trade-off. So it's great to trade Renko, but you really do need powerful leading indicators to keep you from walking into a trade that occurs in a market that simply is chopping. Now I'm going to skip these, and I want to go to one of the key components of what we use to trade, and that is order flow. Now, order flow is an integral part of this system, and it's really a very, very powerful one. And if you look at the standard way that order flow is assessed, I'm telling you, it's done incorrectly, and it doesn't help you trade, because what you need it to be is a forward-looking indicator. You need it to tell you where price is going, not where price has been. A lot of platforms assess the market delta, or they assess the bid-ask differential in each tick or pip or cent value. And I'm going to show you why it does not work. It does not work based on the way that it's assessed on most software platforms. Now you can see this is a little blurry, and I'm sorry for that. I have to correct the slide. This is a positive 29.85. And it tells you that there's more buying pressure in this market at this current time than there is selling pressure. And this is based off of the bid-ask disparity in every individual tick value or cent value or pip value. This is operational in any market, on any instrument, and on any time frame. And I'm going to show you slides on 30-minute charts, hour charts, daily charts. Even though we use a Renko, it's irrelevant. If this is a force that determines the future direction of price, it should be instrument independent. So it doesn't matter whether you trade Forex, futures, or stocks, and it should be time independent. Now, this positive 29.85 is simply telling you something about market depth, and that is that there are more buyers on the dome than there are sellers. And you buy at the ask and you sell at the bid. And you're going to buy at the more expensive price, which is the ask, and sell at the cheaper price, which is the bid. And what it does is look at that bid-ask disparity. Now, if this was as accurate as we might think it is, every positive delta would be associated with an up candle. But the problem is that some positive deltas are associated with a down candle. This positive 222 tells us that there's more buying pressure than selling pressure based upon the dome and market depth, but you still get a down candle. So if you're, I'm going to show you in a second, if you graph out the market delta, you're going to find out that it's just simply not going to do a very good job of predicting the way where price is going to move. It's the same thing by looking at the bid-ask disparity of any individual tick value. Remember, these are not executed trades. These are just traders sitting on the dome. In this particular case, sellers were more aggressive than buyers, even though there were more buyers present. So it leads to a problem. How do we leverage the volume ladder and market delta to actually create an indicator that has forward-looking ability and is really, really precise and extremely accurate? If this data can lead to such a bad misinterpretation of where price is going to move out into the future. And that's what's going to happen if you look at a simple bid-ask disparity of any given tick value, pip value, or cent value, or the individual market delta. Now, if you look at this whole series of candles, you can see that in general, a positive market delta is associated with an up candle. And in general, a negative market delta is associated with a down candle. But if you use a chart like this, you see this big minus 2239, that shows huge selling pressure, but it's an up candle. All it's really doing is showing you that there are more sellers on the dome than there are buyers, but the buyers are simply more aggressive. So even though you have a very large negative delta, which pushes this to the down right here, you still get an up candle. So tracing out this chart, which is simply the magnitude of the delta, is not going to tell you where price is going to move. And this is the most common way that the delta is displayed. And on the right edge, you have a down candle with a down delta. And you can see that this is moving up. What you would tend to believe that this is going to tell you is that the next candle is going to be an up candle because this is moving to the upside. But it in no way is going to tell you how price is going to move on the right edge. So what we've done is determined that one standard deviation's worth of market deltas close in the appropriate direction, i.e. if it's positive, the candle closes up, And if it's negative, the candle closes down. The problem is to get rid of the outliers. And the outliers are where you get an overabundance of buyers, but the sellers are more aggressive. That doesn't happen very often. And it only happens, and if we can, again, if we can eliminate anything that's outside one standard deviation's worth of data, we can make this work. And I'll show you how we do it. What we do is, our order flow assessment is we look at the two higher time frames. We don't look at anything that takes place on the trading chart. Now, if you're trading a time chart and you're trading a 2-minute, it's going to look at a 6-minute and an 18-minute. If you're trading a range, a 5 range, it's going to look at an 8 range, and it's going to look at a 13 range. Those are all fib numbers, and it's going to give you the two higher fib numbers. If you're trading a tick chart, if you're trading, say, I think 244 is a fib. I might be wrong on that, but you're going to trade it's going to go to the two higher fib numbers. So it only looks at the delta of each candle on the two higher time frame charts. On the Renko, it's going to look at the 2 and 3 multiple. So if you're trading at 2 Renko, it's going to look at the 4 and the 6 Renko. But the principle is we're looking at the two higher time frames. And then in order to get rid of the outliers and just look at one standard deviation's worth of data, we put the market delta that's created by these two higher time frame charts into a 15-period simple moving average. And that allows those outliers the inability to skew the slope of the simple moving average. So when you get that errant market delta that's positive and creates a down candle, it doesn't appreciably change the slope of this SMA because it's looking back 15 different derivations, of which the vast majority are the delta is going to close in the direction the candle closes. So we look at the slope of those two SMAs, and when both of those SMAs are sloping up, definitely the bulls are in control. And you're going to see that when I show you a live chart, and I'm going to show it to you on the slides. When both 15-period SMAs are sloping down, you've definitely got the sellers or bears in control, and the order flow line is going to be red. And when that 15-period SMAs are not in agreement, it's going to be yellow. And that's going to define chop for you. Now, on one line, it's going to be tough to define chop, but you're going to see that we're going to add additional parameters. But when the line is yellow for an extended period of time, you're going to stand aside because these SMAs are moving in separate directions. And these are forces that move price that must be aligned in order to take a trade. Now, I said they were leading indicators, and they really are. The order flow line is going to turn green before price starts to move up. And you're going to see that on the Legear. It's really prominent. Legear momentum will go positive before price starts to rise. Now, this is those two SMAs on the higher time frame of this chart. And I purposely did not put in a Renko size or an instrument because this is instrument independent, and it doesn't matter whether this is a stock or a future or a Forex or what market it's trading. When the order flow line goes green, now we're only looking at a directional bias here. We're not looking at an entry. You have to trade long. And if you try to counter trend trade it, you're going to wind up getting into trouble. Now here, you could get stuck in a counter trend trade because we only have one parameter, but we're going to add multiple parameters that will confirm the direction of price. And When this line is green, you can only go long. Now, if you want to try to trade a top or a bottom, which I don't recommend doing, you have to wait until order flow changes. If you don't, you're going to get stopped out in both the trend and counter trend direction. Now, there's lots of reasons why you can't counter trend trade, and again, it's beyond the scope of this this lecture or webinar. But it essentially boils down to the fact that there is no such thing as a top or a bottom on the market that any indicator can assess. Overbought does not call a top, oversold does not call a top, and divergence does not call a top. And I'm going to go over that more when we look at the Legear. Same thing. Price turns and moves up once the order flow line goes green and stays green. And if you try to counter trend trade, you're going to get stopped out. And if you're getting stopped out a lot and you're trading, it may be because you're not assessing order flow at all, or you're not assessing it appropriately, and you're counter trend trading against the direction of an appropriate, correct, and really precise order flow assessment. This is really telling you whether the bulls or the bears are in control of the market. And essentially, what it's doing when those two 15-period SMAs are both sloping up and the majority of market deltas are green and price is closing long, it's simply what it's really simply mirroring is the direction of institutional money. Because only institutional money is going to turn those deltas and those slopes positive for you. And that's what we want to do. We want to get in early in a move that's powered by big money. Here's another example. Order flow leads price up. You get chop here. And then order flow takes it down. Order flow goes up. And it's really important to remember this, that this green line is not assessing anything that price is doing on your trading chart. Now, 99% of the time, and 99% of the software you look at, the assessment, whatever the indicator may be, is using data off of trading chart price. So when price goes up, whatever this is doing is going to go green. When price goes down, whatever this is assessing is going to go red. But this is assessing the market delta of the two higher time frames. It has no idea what price is doing on your trading chart. It's not looking at it. But it's telling you that price on your trading chart is going to go up, and price goes up almost always, not 100% of the time. If it did, we'd have 100% winners. But the vast majority of the time, it's going to set for you an absolute direction that you have to trade. Now, when you only have one line, it's tough to know when it's going to keep switching color. It's going to get easier when we add the Legear lines. But you can see when those higher time frame moving averages keep changing direction, they help us define chop. And staying out of a chop market is really the key to making money. When it goes green, up you go. And remember, as day traders or swing traders, our number one goal is not to get winners, it's to avoid losers. Now, there are other mandates, and one of them is to try to wring as much money out of every winner as possible based on your trade management, which is something I did not do that great this week, even though I had an enormously high win percentage. But what we want to do is we always want to trade in the direction of this line, and when it keeps changing color, we want to stay out of it. Now, let me go to the other, that was actually our offer, and let me go to we have another slide deck I'm going to put up, and I'm going to show you the Legear. Now, the Legear is really a remarkable indicator. just take that around. Now, I'm going to just a little bit of background on it because it's a really interesting background if you haven't heard it before. But George Lane was a mathematician who created it in 1957. So the guy was obviously a genius. Now, he created the oscillator. Stochastic. And it was the first oscillator. It was the first bounded indicator ever created. And the guy really was brilliant. If you Google his name, you'll find out that he was trained as a mathematician and he did a lot of other work in math. But what he was looking for with this indicator is exactly the opposite of what we have to do with it now. But he was completely correct in his supposition that the momentum of price changes before the price itself changes. And to give you an example of that, momentum is a second order derivation. And what George Lane was saying, another way to describe momentum is that it's the rate of change of speed or the rate of change of velocity. So the best way I can give you as a sort of an analogy is a race car going around a racetrack. Now, if it's going at 150 miles an hour all the time, momentum is neither increasing nor decreasing because velocity or speed is neither increasing nor decreasing. But if, as the race car moves around the track, it's going from 150 to 160 to 170 to 180 miles an hour, the rate of change of speed is rising. The momentum is going to rise. Now, it has to do better than from 150 to 160 to 170. It's got to go to 150 to 160 to 175. That rate of change in speed always has to be increasing for momentum to rise or for momentum to fall. The rate of change of speed has to be decreasing at a greater and greater rate for momentum to be decreasing to the downside. And his supposition was that this second order derivation in the market would lead price. So what he was saying is if price moved up, but it moved up on constant speed versus price that moved up on accelerating speed, if the second move up on constant speed, it did it with lesser momentum, eventually price was going to collapse. And he was really right. And he felt that the stochastic oscillator should be used only to foreshadow reversals. He did not use it as a trend trading tool. He used it simply to look at bullish or bearish divergence. And his supposition was this is where you counter trend trade a market. So a price made an equal high or a higher high, but price moved up at a slower pace, then that heralded a collapse in price. And this is really kind of reviews what I said. As the price, I put security because it can be any instrument. It could be a stock, it could be Forex. This is a universal principle that as the price of a security rises, faster price momentum increases. The faster the security rises, or the greater the period over period price change, the larger the increase in momentum. And once the price rise begins to slow, momentum will also slow. And the price begins to move up at a constant speed, momentum will flatten. And then if the rise up actually starts to diminish in speed, momentum will decrease. So what I wanted to do is show you the basic oscillator formula. Nobody ever looks inside an indicator, but you get a great idea of what an oscillator is doing if you look inside it. Now, and C here, right here, is the most recent closing price. And all the oscillator does is compare this close to it creates a 14-period average of the session lows and a 14-period average of those 14 session highs. So really you have a 14-period moving average of the low and a 14-period moving average of the high. And on a long move, as price continues to approach the high, momentum rises. And on a short move, as price continues to approach the low, or that 14-period low, then you get momentum to the downside. And percent K is the line that's created, or that momentum assessment based on the close and its association to the 14-period low or the 14-period high. And the percent D is the 3-period moving average of the percent K. So in an upward moving market with upward momentum, price is going to close closer and closer to the high of the move. And in a market trending downward, price is going to close closer and closer to the low. That shows you that you've got momentum to the downside or momentum to the upside. And he believed that a transaction signal is created when the percent K crosses the percent D. Now, in a perfect market in 1953, when there was very, very little charting tools available, I think that George Lane was probably almost always right. And these are just charts I pulled off the internet. Nothing special about them. But you can see here's a double top created on decreased momentum. So this price rose at a slower rate than this price did. This price accelerated faster. This price accelerated to the upside more slowly. It was a more gentle rise to the upside. So you got a lower momentum tracing. Now, he believed the fact that there was less power in the move up here, that was a harbinger or kind of a warning signal to us that the market was going to collapse in price. And that's exactly what it did. It tried to make a third top and then collapsed. And here's just an example that I made. Here, price makes a higher high, but it does an unequal momentum. So on the same amount of momentum, if price rose higher, it had to have risen at a slower pace. It accelerated up to this price more gently. And that heralded a big collapse in price. So divergence back in 1957, I believe, was a major signal that worked the majority of the time. Now, this is a bad example of a divergence failure. Now, again, in a perfect market, and this was the kind of market I bet you saw more commonly in 1957, every time you got the stochastic line to cross above the 20 line, you got an up signal. And every time you got the stochastic line to cross below the 80 line, you got a down signal. Here you didn't go very far and it probably was a loser. But you got the line here, and this gave you a big move down. And you got the line here up. Stochastic line, this is the percent K, crossing the 20 line, it gave you a big move up. And this, we just don't know what's going to happen ultimately here. But we're in a different market now. And here's a chart that shows that overbought with multiple divergent signals no longer it really works very well. Now, occasionally divergence will work, but if you try to trade a signal that works sometimes and fails others, and you can't tell when it's going to fail, and you can't tell when it's going to work, you can't trade it. And the reason it fails now so often is because of institutional money. Institutional money will drive the price of a stock or a Forex market or a futures market up as far as it wants to. And it'll create multiple divergent signals because it may drive that price up on lower momentum. But as long as it's not done, it's going to continue to drive price up. And you see counter trend traders getting run over right and left. You can't trade oscillator divergence. You cannot trade MACD divergence any longer. And so what I've created are sort of a series of trading rules that I think that you must adhere to in order to trade profitably. And really, this is just a recap of what I said. When oscillators were developed, there was little to no institutional volume in the market, and it goes right back to the Japanese candlestick principle. The power of each buyer was approximately equal to the power of each seller. In that environment, that divergence signal was a very successful one, and Japanese candlestick patterns were probably very, very powerful. Both of these are no longer true, and institutional volume now dominates, and that determines the direction of price. Nothing else. What we need to do is track this volume and trade with it. And I'm sorry if I'm getting a little bit hoarse, but I do have a little bit of a cold. And I actually just saw my doctor in a virtual room. I didn't have to go to his office. So in the era of institutional volume, how should you trade this indicator or any indicator? Number one, you have to understand that there's now no such thing as overbought or oversold. The market will continue to go up as long as institutional money is pushing it up or pushing it down. And there is no indicator that is out there now or will ever be out there now that will tell you what institutional traders are going to do. There's no mathematics that's going to tell you when a computer-generated move by big money is going to start to power crude oil or a stock to the upside. It's just not possible. The other thing that this has really hurt is Gann Theory and Elliot Wave. I mean, those were principled on these intrinsic waves being present in the market. Well, those are destroyed completely by institutional money, just driving the market up. And what they usually look to do is to run over a lot of traders caught in the counter trend direction. I mean, that's how they look to leverage their money and make it move the market even further. They don't care about Elliot Wave. They don't care about Gann Theory. And frankly, they don't care about Fibonacci, which I think is a bunch of hooey. This is all that really matters, is tracking the direction of institutional money. Now, markets are going to reverse only at the whim of institutional money. When we know for sure they have stepped aside, the market will reverse. But we never are going to know. And what happens when they actually do reverse? You get a reversion to the mean. Now, the reversion to the mean still applies. It's a mathematical axiom, and it's never not going to be applicable. But the concept has been skewed because reversion to the mean is not going to occur until institutional traders are done powering whatever you're looking at to the upside or the downside. But what I found is the farther up they push it, In other words, if you take the mean price, which you can call your 50-period moving average, or your point of control, it doesn't matter. Point of control is really mean volume. It's not mean price. So it's a little inaccurate to call the point of control mean price. The further up they push it away from the mean, or the more standard deviations they take it off the mean, the faster it will snap back to the mean when they step aside. The only problem is we don't know when that's going to happen. So trading divergent signals today is tantamount to trading against the flow of institutional money. And if you try to do it, you're going to get majorly beaten up. It's very different from 1957. So all these oscillators that are variations of stochastic, which are created essentially to track momentum and look for momentum divergence, are going to fail. Now here's the Legear. Now the Legear is a very, very different type of oscillator. Now if I put up relative strength, it's a much more complex equation, but its core is the same as stochastic. The same thing with Williams K. They play with that core formula, and some of them do it very cleverly. But the core mandate of those indicators is to look for a divergent signal, not to capture a trend trade. But the Legear is very different. The Legear has a gamma factor, which we can modify to change the speed of the Legear line. And it has multiple filters, which changes sensitivity and specificity. And what that really comes down to again is changing the stability and speed of the Legear line. And we've modified it quite a bit to create a Legear with a lot of stability, but also with speed. Now I wanted to show you some trades we take with the Legear. Now this is just the chart Legear. We've created a multi-time frame assessment that has tremendous power. Now momentum does lead price as long as you use it to trade in the direction of momentum and not counter trend trade it. Now here's a trade of the Qs on a 30-minute. Now the arrow, which is traced on your chart, it flickers intra-candle and prints if the candle closes up, which means this Legear line closed above the 20 line. Forget this yellow line, I've taken it out. It's called fractal energy, and it's supposed to do an assessment of the potential size of the move. And it's sort of an ADR ADX calculation looking at volatility. Just is not any good. We haven't modified it, and we actually got rid of it. So we're just looking at the Legear line, which is this, this is cyan. Crosses above the 20, gives you the entry. And then the Legear locks long. Now, back in the old days, this long lock, you wouldn't trade long, you'd look for divergence. We're going to leverage this because we don't just believe, we know that institutional money is creating such buying pressure in the market. It's locked the Legear to the top. It's basically locked at 100 or above the 80 line. And we're going to trade this long. And this gives you a great long move. Now, if you want to exit on the drop of the Legear across the 80 line, here's your exit signal. If you want to exit on a break of support, you can get this whole move. Now, here's another move. This is an even easier one. This is a 1 hour of the Qs. There's your Legear arrow. Now, the software does the printing of this arrow. I didn't put that there. And it flickers intra-candle to give you the opportunity to take the trade short, one tick below the close of the candle, when the arrow will print and never move. Nothing reprints or changes. It shows you that the Legear, that momentum is now moved to the downside. And what you want to see is it locks short. And it locks short here. And you just ride this thing down all the way. And the only time you would consider exiting is on a move up above the 20 line, which is right here. And it gives you the vast majority of a huge move on a 60-minute chart. I mean, this is a stupendous move. And here's a daily. And the reason I wanted to show you this is I wanted to show you that you can trade it on stocks, you can trade it on Forex, you can trade it on futures, and you can trade it on any time frame. It does not matter. It's a force that's independent of all of those things, just like order flow is. Now, the Legear drops below the 80 line twice, once here and once here. Or you can take it on a break of support, but your entry is right here. And this is a daily, so you get a nice move up. Now, you would exit here conservatively, but you're always trading in the direction of the Legear lock and the entry and move up. And all you're doing is tracking the flow of institutional money here. Now, here are the futures. There's the Legear. There's the movement of the Legear across the 80 line. It then locks short. Down you go. There's the exit on the line rising above the 20 line. Same thing happens here. There's the arrow. The Legear drops below the 20 line, locks short, but just for a short time. Takes you out right here. But it's still a very, very nice move to the downside. And you have no other move to the downside again. Now, I wanted to show you the comparison of the Legear versus stochastic. Remember, the stochastic was engineered to look for divergence. Wasn't meant to track the trend of a trade, just like RSI. Now, you get, if you use the stochastic to get you into this down move, you're going to get in 2 candles early, right here. Here's your Legear entry, right here on that arrow. But the stochastic line comes above the 20 line and takes you out right here, where the Legear stays below the 80 line. It locks short, and it takes you across this whole trade to the downside. The only potential exit will be right here on this up arrow. Because the Legear has stability and smoothness. But I'll tell you, as soon as momentum wanes, it rockets up. And you'll notice it moved up with the same speed as the stochastic. But on these false moves, where there's the potential for a break to the upside, the Legear didn't budge. Momentum here was always angled to the downside, and we have to trade in that direction. Stochastic gets wiggled out, the Legear stays in. Now here is, I don't know if I'm going to go over this. I think it's actually worth going over, because you're just going to have 2 assessments, not one. But what this does is it looks at order flow, and it looks at the Legear. Now, I don't have the multi-time frame Legear up, and that's going to be up on the chart that I'm going to show you. Now, there's the Legear arrow long, and you can see order flow is locked long. So it makes the predictive value of this long entry even stronger. What I wanted to show you here, and I kind of obliterated it with kind of a poor drawing. This is, we call this a number 1 entry. And this is an entry on a Legear arrow. A number 2 entry is a pullback to support on a long trade. with both lines locked green. There's no arrow. You're in the middle of the move. I kind of eliminated this big wick by putting this black line here, but this is a number 2 trade, where if you pull back into an intact green line, the chances are the trade is going to continue to the upside, because institutional money is not done with, still going to push it up higher. Now this is the NASDAQ, but it doesn't really matter whether it's the NASDAQ or whether it's a stock or whether it's a Forex market. Here's another example. This is a number 2 entry. You get a move down. These two crazy counter trend traders trading against the direction of momentum and order flow. You just wait for the roll. And if you're red, the Legear's locked short, order flow is red, and you get a great move to the downside. And let me tell you, these counter trend traders help you, because when you get traders caught in the wrong direction and they're to the trend, they're going to get run over. And as they get run over, they're going to have to sell their contracts to get out of the trade, and they're going to help push this move down. So what we always try to do is leverage traders caught in the wrong direction. That's why the entry is so powerful, because you need a couple of counter trend traders who are trading oscillator divergence, MACD divergence, caught in the wrong direction. We run them over and it helps them move. Here's a number 1 entry on an oscillator signal. The Legear hasn't, because we're just getting that cross of the Legear line across the 80 line, but we're in the direction of order flow. And eventually the Legear locks short, and we take it in the direction of institutional money. Those are our 2 trades. Our number 1 trade on an entry on a Legear arrow, our number 2 trade on a pullback and continuation with both the Legear and order flow in our direction, in our favor. Here's another number 2. Looks very similar to the other one, but it's, hang on one second here. Yeah, Rory just paged me. I'm going to show you the multi-time frame Legear on the actual live chart. And here's another trade. This is a number 1. There's a Legear arrow. Always, you have to have order flow. And you're going to see on a live chart that sometimes you don't. And when you don't have order flow and momentum aligned, you step aside on the trade. Some of them may work, a lot of them fail. The point is, on the right edge of the chart, you know that there's too much associated risk. And your goal here is to avoid risk. That's how you become profitable. Now here's a couple of entries. Here's a number 2. Here's a big pullback. We got 3 sets of 3 candles, all with short traders caught. This is, and we get the move back up. The Legear on these 3 never dropped below the 80 line. So the Legear line stayed green. Order flow never changed. It was always green. And so we take the continuation up. Here we have the same thing. Here's a number 1. We've got order flow, and we've got the Legear crossing above the 20 line. And so we take the trade long. Now, I just want to add one other, one of our other trading rules is we never go short below the 50 or long below the 50. So these counter trend signals, and this one worked great, we never take. We only trend trade long above and short below. I believe that when the market's above the 50, bulls are in control. When it's below the 50, bears are in control. We only trade short below and long above. Now this line is a 50 exponential of a 50 exponential. It moves like no other line. It has real speed, but again, stability. And this is a 15 exponential of a 15 exponential. This is an optimized platform. It moves as fast as a 15 EMA and has the stability of a 15 SMA. And if I overlay the two, you'll see it's really remarkable. You see how these three candles just changed it from green to yellow? On an EMA, it would have pressed it so that the slope of the EMA was short. The slope here never went red. It always stayed yellow. That's its stability, but it still has the same speed of an EMA. It makes it much easier to trade, and they're great areas of support and resistance. This is a 50 period. So this is the average price over 50 candles. So it's a great area of support and resistance. So is this. Okay, well that's our offer. I'm not going to show you that again until, let me show you a live chart. Everybody can always show you anything they want off of slides, but I'm going to put up a chart here. Now, this is, of course, is the wrong one. Let me find my chart. Here it is. Now we have to add another component to the trading. And so we make it a little more complicated, and we also make it a little simpler. Now here is the order flow line, right here. It's this upper line. Now, you have to pay attention to three lines. But in order to make it simpler, what we've done is the candle halo reflects order flow. So all you have to do is look at the candle halo, and that will tell you the direction of order flow. So what I'm going to do now, I wanted to show you that. See how the candle halo here is red? You can see it exactly mimics what's going on our order flow line. So if you can make this assessment off the candles, you're welcome to leave this line in. But what I'm going to do is I'm simply going to go in and make the order flow line. Oh, that's the outline color. That's not the one I want. Hang on a second here. Can't find the order flow line, which is wonderful. I don't know what Sergio called it. Hang on a second here. I'll find. Here's the line. It's 25 point. What I'm going to do is I'm going to make the order flow line transparent. When I do that, I eliminate the line. Now what I can do is when it's transparent, I can put it, go back, I can put it in as the same as the input series. So if I do that, I can move everything up one. I'm just going to do that. You see, you have one less line to look at. Now, all you have to do is look at the long-term Legear, the short-term Legear, and the candle halo color. And it makes the calculation much simpler. Now, the upper line is long-term, and the lower line is short-term. And the candle halo is that multi-time frame assessment of order flow. Now, this is actually an entry right here. Remember, this is the short term, and there's the short term generated long arrow right here. And all we want to do is make sure it trades in the direction of the long term. And this long-term assessment is a terrific momentum assessment. And you always want to trade the short term into the long term. You get the Legear arrow on your short term. You see the candles haloed in blue, which means you have order flow. You have the long term. It's a fast assessment, and up you go. The only problem is you have to trade into a pivot. And pivots are very difficult. And if you didn't want to, you could trade around it just by taking the trade on this pullback. This is a number 1 entry, and here's a number 2 entry. And up you go. Now you have both Legear lines locked long, just like you saw on the slide, and the candle haloed in blue, which means you have order flow to the upside. I mean, the likelihood of this being a winner is over 90%. Now, you're going to get a lot of trades that you can't take. And that's the problem with specificity. Now, if you want a lot of trades, well, you're also going to take a lot of losers. And you're just going to wait for this to occur again. And you have it right here. This is a number 2. You want the counter trend trader to take his shot at reversing the market. And you have a little heat, but it doesn't matter. Both lines are locked long, both the short-term and long-term Legear. The candle's outlined in blue, order flow is in your direction, and up you go. You have the same thing here. You have a pivot, and that's a problem. It all depends upon your assessment of what you want to do with them. Up you go. The same thing here. Up you go. You're always trading a pullback into the direction of the multi-time frame Legear, your trading chart Legear, and order flow. Now, really, if you look at this, it's going to be very, very difficult to find a loser. And you have right here, you have a trade. It's a number 2. Down. Now, this is why I warned against trading into pivots. Pivots are the pivot indicator. I want to talk for a second about our pivot indicator. And the first 10 get this pivot indicator. And I think it's one of the few accurate indicators. And look at this move down. Now you can't get it on the Legear cross right here. And actually you do get it. And this is a loser. I don't want you to think you're always winners. This is a loser right here. Legear crosses the 20 line in the direction of the longer term. Right here. But then you get this number 2, and you get the whole move back. Now, I do want to talk about the pivots. Here, there's no trading. You have no long term. Here, you're trading back up into a pivot. Now, I want to show you how a pivot's assessed correctly and what makes these pivots so powerful. A pivot should be created from a candle body high, not from a wick high. Now, this is Japanese candlestick dogma. Most pivot indicators create their high off of the wick. They should come off the candle body. Now, there's all sorts of sophisticated stuff out there to tell you where there are hidden buyers and hidden sellers, but this pivot tells you more information than any of those indicators put together. There's a ton of hidden sellers here. They're not so hidden anymore. And look what happens when price comes up to it again. It turns. This will happen to you over and over and over. Now, obviously the pivot will eventually break, but if you don't know when it's going to break, I used to think Hit once, it holds. Hit a second time, it holds. Hit a third time, it's likely to break. I've seen these pivots hit multiple times. The other thing that's really important about a pivot, and again, which is rarely assessed, is it's not broken on simply price coming above it or price breaking it. These sellers are all still there. It's only broken on a 2/3 candle close above it. And that's how our pivot indicator is calculated. It will only stop tracing when 2/3 of the candle body close above it. That's a tough calculation to make, but that's why the indicator is so different. And it really, really tells you when to stay out of a trade and how to trade around a pivot. So let's take a look at a chart, a daily chart, and I'll go through a few, and then you can tell me anything else that you want to see. Now, right here is a long trade. It's a perfect trade, but you have to break the pivot, and you have no guarantee. So you hold off and trade around it, and you take the pivot breaker right here. This is the candle that breaks the pivot. I'm giving you a little bit more trading methodology here, but this is really important to take a winning trade, and then up you go. Right here. Same thing here. There's your entry. Don't take it. Trade around the pivot. Take it here. And up you go. And you see how you have a potential long signal. Well, you don't here, because here the Legear momentum is sort of moving to the downside. But you have the pivot. It's unbroken. You can't trade it. But here you don't have order flow with you on the trade. You got magenta candles. You can't trade it. Now you see this long trade here? The pivot's right here. And if you traded it, it would hit and bounce. It hits, and this time it goes through, but you would trade around it. There's your entry. Well, you don't have an entry here at all because you don't have the long-term Legear. I don't want to confuse you. I have to pay closer attention there. Here's another long trade. I mean, there are a million of them. Here, you don't have the trade because your chart Legear is not heading up. And you have to look if you don't have an arrow. Here is your gorgeous trade. Both lines lock long. Order flow up. Here, smaller trade, long. Here, you don't have the long term, so you cannot trade it. See, this is yellow, can't trade. Even though it works, you want to stay away from it. And there's your perfect trade, right there. Red, red. Perfect. So if you have patience and you wait for the candle to be outlined in order flow to the downside, and you've got red here and red here, you have a number 2 entry that's very likely to win as long as you don't trade into a pivot. Here, you had a pivot, can't take the trade. Now you could trade around it here, and you'd still have a winner. And here you have nothing. The long-term Legear is gone. And here's your next trade again, right here. Break and down. So you can see how well it signals a trade. And it's going to keep you out of chop. Here crude is really trending. Let's find a choppy market, and you're going to see, like right here, where the market's all choppy, look at the Legear on your trading chart. Now you're looking for a short trade, but there's no downside momentum on this Legear, and there's no down arrow. and there's just no way you have a trade here. I mean, there's an entry right here. You really have no downside movement. And here's where you get your trades, right here. No trade here. You don't have a trade here. You need to have them both. And you're not only going to have your long term. Now here you do. And here's your long. So that's the indicator. Here's the long-term Legear, the short-term Legear, and the candle halo tells you about order flow. Now, order flow can go red in the middle of a move. It does not matter. As long as you're in it, you have an automated trade management strategy. It's not an exit signal. As long as you've got the move moving in your direction. Here, you don't have order flow. Still works, but that's a perfect signal if you had order flow. Here, you just missed your long-term Legear. Hasn't turned red yet. And here is your perfect entry. Look at this trade. It's 11 o'clock in the morning, right here. On number 2 on a pullback. That's a huge move. I'll just scale it, and the likelihood of that losing is very low. 35 ticks. I mean, you get one really, really nice trade after another. Here's another one. It's a much smaller trade. Our first target is 6. And that went 7. Here you lose the long term. So you can't trade anymore. Can't trade that trade. Here you don't have the long term. You have no trade. Here you don't have anything. So you have no trade. And here you're looking for a short trade. You have it right here. And this candle breaks the pivot. 2/3 of the candle closes below, and you have a nice move. Here you just don't have a trade. Breaks the pivot, but I don't see any real downside momentum on my Legear. I would hold off on this. You only want to take the really, really lowest risk trades that you can get. And right here, without the long term, just have to let this go by. It's 1,600 hours. So I don't want to beat a dead horse with this. If you want to see other instruments, I'll be happy to show you. I can show you stocks. I can show you other futures. I'll just really briefly show you the Qs. Let me show you the NQ, and then I'll show you really briefly the Qs. And then I'll show you the offer, and if there are any questions, just let me know. I mean, these are core principles that we use to trade by. Here comes the NASDAQ. Now, the NASDAQ's brutally difficult to trade. And we did really well with it. The only problem I had on the NASDAQ this week is I didn't milk the trades enough. I mean, we had 40 points in one day. And I just didn't get enough money off those trades. Now, the NASDAQ is a 10, a 4, and a 20. Remember, every instrument has its own setting. So let's just reset the size. And we'll just look at a few NASDAQ trades, and then we'll just look at a few Q trades. Okay, here's the NQ. And no long term. Can't trade it. You can't trade here. You need the 15 above the 50 to trade it. No trade here. Long term is not there. Here's one trade right here. This is a really nice trade. Now this is, I remember this is a 4-unit Renko, so this is a very big move. I don't want you to be deceived. This is an 8 3/4 point move. This is not a small move. Can't take this trade. If you want to trade with multi-time frame alignment, here's your trade right here. Yeah, it's just trading around the pivot, and you get the break. And you have to assume the upper pivot will break. It's a discretionary trade. And look at this trade right here. There's your wick, and there's the trade. It's a number 2. Did we actually get an? Yeah, but see, we have a number 1 short, but the long-term Legear censors the trade. And I'm just moving away from any of the pivots. Here, no long-term Legear. Here, no long-term Legear. Saves us these trades. Here. Now this trade is a small one. It's 4, 8, 12. It's about 14 ticks. It's not a huge trade. Here, there's no trade. All right, let me show you the cues. The rules are simple, and the trades are easy. And the only other thing I would add is don't trade when there's hardly any volume. Like, don't trade in the middle of the night. You know, don't trade if there's hardly any volume crossing. You want to trade in an environment where there's a decent amount of volume. That's why I try not to show you trades that were taking place at 4 o'clock in the morning. Now here's the cues. Now we just don't have a trade. There's the pivot break, 3 line. We don't have order flow. And here, look at this killer trade right here. And this is just trading around the pivot. You've got the Legear arrow. Just take the break right here. And you've got that whole move up. Now, the likelihood of taking a loser here is very low. And look what happens if you try to take a long. Now, you don't have permission to do so, because the long-term Legear is partially green, but your short-term is red. This is how they censor the trade. So you don't have green, but you're also trading into a pivot, and the pivot comes up, stops price. Comes up, stops price. Right here. So then when you come up over here, you're going to wait for the price to break the pivot. And when you do, you've got yourself a great trade. And look at the momentum line on your trading chart. Because you've got the arrow, you know you've got the okay. And your long term is green, and you've got that trade. Just going to look this is actually another trade right here. Here, right to the pivot. So I think you got the idea. And the multi-time frame Legear, this upper line, you never want to trade against it. You always look for a long trade when it's green, and always look for a short trade when it's red. That's sort of like your baseline. Then you look for the candle halo and your trading chart Legear. But this is the center of the wheel. If it's yellow, you don't look for anything. If it's red, you only look for a short trade. And if it's green, you only look for a long trade. So it really sets a direction for you. And if you counter trend trade this, you really got trouble. I mean, if you try to take anything long here, it's not going to go very far. Here is where you got your great trade. Here the market turns, but it still collapses, and you don't really have a good short trade here. You have to stay in the direction of this multi-time frame momentum assessment. It's extremely accurate, and it's looking at 2 higher time frames, which is why it does. Now, we can make it move faster, but I don't want it to move faster. When it moves in the direction of the trade, I want it to do so with so much power that it's going to get you a winner. And we could do a faster speed. I don't want it to. And you see right here, you get multiple opportunities to take a number 2 right here, and down you go. I mean, that's what we're looking for. An entry with a predictive value of winning that's, I think these are above 90%. And here on the pivot break, right here, this is essentially a number 2, because you've got this down candle, and you take this entry, but you don't into the pivot. You just let it go until you break the pivot, and then take it up. It's really a number 2. So there are very few trading rules. Long above the 50, short below the 50, and trade around the pivot. That's it. In the direction of this assessment, along with the direction of order flow. Let me show you the offer, if I can find it, and then I'll answer any questions you have. That's not it. It's right here. It's called the Legear order flow trading system. It's normally $19.99. Lifetime license is $6.99. Now you're going to get free upgrades for life. And if you own a portion of the system, you just have to talk to Rory. You're going to get 1 month in the live trading room with me. You're going to get a 10 module educational. You're not going to get it every week. You're going to get it. You're going to get the whole 10 modules. You're going to get 250. I think it's actually 450 videos in our tutorial library, and the first 10 get the pivots. Now I didn't change the date correctly. It's Sunday the 17th, not the 10th. Sorry, I put it the 7th and I didn't save it. So that's the offer, and here's our phone number if you want to give us a call. So let me look at the questions. Hang on 1 second. I'm going to drag them over. Okay, we have a lot of people in the room. All right, hang on 1 second. I'm going to answer them all, and I'll read them out. So let me find them. Okay, hang on. I got them. All right, hold on 1 sec here. Let me go to the top and start from the top. Let's put this all to the side. Whoops, it won't do it. Let me do it this way. I'll just leave our phone number up there, but that's the offer. Okay, the first question. They're all done, Robert. You would get them immediately. Okay? Hi, Al. How you doing? Okay, Noel. Oh, hi, Terry. Oh, thank you, John. I'm actually my voice is clearing a little bit, actually. Yeah, you know what, Isadora? TradeStation we're just not programmed for. If you want, you can use this on a demo of Ninja with a demo data feed and take your signals from it and trade them on TradeStation. But we're not on. We aren't on TradeStation. We're having so much trouble keeping up with NT7 and NT8 right now. We're almost on Sierra. Well, here's the thing, Isadora, is that NinjaTrader doesn't have Unirenko either. we provide you with the Renko candles, but we can't do that on TradeStation though. But we would provide you with the candles. No, it's not going to work. I mean, the Renko candles we have are really a little bit unique, and I didn't really show you the full extent of them because I did not want to. Put up too much data, but and I don't want to do it now. But our Renko are really different. They're hollow. And there's a different component. So you really have to use them off of Ninja and take the signals on TradeStation, Isadora. Yeah, Jose, the Legear, this line is analyzing multiple time frames. If you're using a Renko 2, it's looking at a 4 and a 6. If you're looking at a 2-minute, it's looking at a 6-minute and an 18-minute. If you're using a 5 range, it's looking at an 8 and a 13 range. It automatically looks at the 2 higher fib numbers or the 2 multiple higher time frame numbers. It's all programmed into it. You don't have to do anything. It's automatically going to set those for you. Okay, Jean-Paul says, nice when it is like now, but real time, you never know the movement of the next 300 milliseconds, certainly when you have a VIX range. So listen, this system is geared to keep you out of a trade and chop. That's why we kept the Legear from your time frame. And the long term has to come into alignment. Remember what I said. You look at the direction of the long term and look for the Legear on your trading chart to come into sync with that long term. In chop, it's not going to happen. And you're also not going to get order flow because it's a multi-time frame assessment. And it's really not common to have 3 time frames come into alignment. So it's meant to keep you out of trades and chop. When you trade with specificity, if I could find an area chop, I would show it to you. And let me tell you, there's plenty of them on the NASDAQ. Just let me find one. I mean, if you look right here and look at the long-term Legear, it's all yellow. In fact, throughout this whole move here, this move down, this move up into the pivot, this move down, a candle up, a candle down, a candle up, it's yellow. And even though price moves up on your trading chart, the long-term time frame is red, and you can't take this trade. I mean, it's a very specific system, and this is a good indication that it's not looking at price on your trading chart. The Legear on your trading chart is rising, but you wouldn't take it because it's not rising into a green long-term Legear. That's what keeps you out of chop. And you don't get them aligned all the way till the end of the trade. This one is just not a tradable entry. And that's the way the system is configured. You're not going to get every winner, but it's configured to try to allow you to avoid almost every loser. That's our job as swing traders. And you see this trade here? Here, you have the Legear and the long-term aligned right here. And here is where you get the winner. And you have to close the trade at the pivot. There's resistance. When that short term, the arrow or the lock, locks in the direction of the long term with order flow, candle haloed, the likelihood of the price rising is very, very likely. It does tell you the direction that price is going to move on the right edge. And it does it really with a great degree of power and precision. And like I said, we could speed this up. You're going to get into more winners. but you're also going to suck in more losers. And our goal is to try to trade, just cherry pick the beautiful trades and sidestep almost as many losers. Try to sidestep almost all the losers. That's specificity. And you always have to give and take. I mean, you can make the system so specific, it takes one trade a year, or make it so sensitive, it takes every move. Somewhere in between is that perfect trade-off where you've got such specificity, almost every entry will be a winner, but it's going to sidestep almost all the losers. The price you pay is you're not going to get into every winning trade. But as day traders and swing traders, we can't care about those if we want to trade profitably. If you want to get into every winning trade, you're going to wind up going bankrupt. Exactly, Michael. The entry is the close of the candle, one tick above. Because remember, this arrow is going to flicker until this candle closes and prints. All this is doing is telling you that you have a potential long. So as soon as you see it flicker, you're going to put a buy stop one tick above the close. So if for any reason the candle collapses, the arrow will leave and you have no trade. If the candle prints, the arrow prints, it never leaves, and this is going to give you a winner. So you get a nice heads up on the trade. As soon as there's a potential for a trade, that arrow will flicker. And sometimes it doesn't close to the upside. It winds up reversing. No arrow, no trade if your buy stop is there. We have back tested it, Ken, and we don't back test it. We can't look at the profit factor. All we can do the way we do it, I'm being honest with you, is we look at the percent winners and the percent losers, because a profit depends on your trade management strategy, the number of contracts. Some traders on a small account have a very, very modest trade management strategy. They'll take a tight first target, or they'll take everything out of the first target. All we can look at is we set our first target, which on crude oil is 6 ticks, on the NASDAQ is 15 ticks, on the Dow is 15 ticks, on the E-mini is a 1.5, and see how many trades get there. Over 80% of your trades will get there, and that's a year of forward testing. What we do is we load the system up and do market replay, and we do it at 500 speed, and we can do the testing in a forward direction over 1 year in 3 days. It takes 72 hours to rerun a year of data at 500 speed. So we have the system tested, and we have it tested on futures and on stocks, just the Qs, and on a couple of Forex pairs, and on many futures markets. So I can't give you profit factor. I can give you first target hit, and that's about 80%. And that's, for us, where you make money. If you want to set a first target at 10 ticks, that's a lot of risk on crude. If you want to set it further, but you have to set some target. And that's the best you can do when you back test or forward test. You have to define a winner. The 50 Don is a 50 exponential of a 50 exponential. And I'll just show you real quickly. I would say real quickly. Let me show you the difference. I'll go to the indicators. And show you how different the 15 is. Let me go to the EMA. Whoops, I just dropped in 5. Let me just show you one. I'm gonna make it real thick. I'm gonna make it like, I'll make it like 9. And we'll overlay the EMA over our 15 EMA. and you'll see the difference. Now you see our average moves just as fast, but look what happens to the slope of the EMA on this 4-candle pullback. Now it's kind of obliterated, but our line stays fairly flat. The EMA bends down. Let me give you a little better example where you can see it better. Look at this 1-candle move up. You see how the EMA bends up? But look at our 15 EMA. It's completely flat and doesn't even budge to the upside, whereas the standard EMA gets pushed to the upside. It's got equal speed, but it's got more stability. So it's a much better line to track price. And let's see if we can find a couple of 2-candle pullback moves that are easier to see. You see our line is pretty flat. This line almost reverses in slope. So it is a much better line to track. You don't get these jags. And you see how this candle almost pushes the line down? We don't allow that to happen. Same thing with the 50. It's more stable than the 50 EMA, and it's much better to track price. And it doesn't wobble in a small move like the standard EMA does. So it's an EMA of an EMA. Sure, PL. Let me look at it. I got to put that in my instrument manager, and I will. PL is wants to look at Boeing. I think the ticker is BA. It is. Let me bring it over and hit OK. Let's bring up Boeing. Now I shouldn't have brought it up on a 2-unit Renko because it's an expensive stock, and we need a much bigger candle size. So it may take a minute for the chart to load. I mean, 2 cents on Boeing is nothing. So it's gonna create a lot of candles. So we're gonna have to wait a second. I should have brought it up on at least a 6-unit Renko, maybe even an 8-unit Renko. We'll just give it a second to load, and we'll look at Boeing. While it's doing that, I'm going to continue to answer questions. It will eventually load. Yeah. This is a live chart, PL. Yeah, the curve on Forex is about 80%. 80% or greater. Now, I will show it to you, but I have to let Boeing load, and then I have to hook up my Forex data feed, and I will show you the Forex on the system. It's really easy for me to do. I got stuck here with a 2-unit Renko on a very, very big chart. And that was a mistake, but it'll load. If it doesn't, I'll just click the chart out. I have the template, and I'll make a new one. And I'll put Boeing up on a 6. Yes, Dale, we'll do that. Just Dale, if you would send an email, I would really appreciate it. The webinar is recorded, Emma. We're going to send it to you. We don't have an alert yet, Randy, but we're going to create one very shortly. We're going to do it on the for the signal. Sergio's going to put in a WAV file for that. It's really easy. Okay, Emma. I have Forex and I have I think I showed the NQ. So I think you're okay. Okay, all right. We got the long bond. What I'm going to have to do here is I may have to click this chart out. I have to wait for it. It's going to click the whole program out. I jammed it up with the 2-unit Renko on a very, very expensive stock. And that was a big mistake. I may have to close Ninja and reopen it. You know, I'll do that. I'm going to close it, reopen it, and while it's reloading, I'm just going to answer more questions. And it'll reload really quickly. And then I can show you all these markets. I'll show Google. Just got to set the right Renko. And I'm going to go back. Steve, I'll show you those today. I took 3 trades in the room. I took 2 winners and 1 loser, and I'll show you the trades. Okay, more market requests. Just let me wait these numbers again for the NQ mark. I'm not sure what numbers you're looking at. No cross. I'm going to show you the 30-year bond. We do, Michael, but you know what I do? Sometimes I have a habit of when we get close to our first target on the NASDAQ to bring the stop to break even. Now it's on a 25-tick trailer because that's the way we've configured it. And a lot of trades went like 12 or 13. Our first target's 15. I brought the stop to break even. We have 1 trade that hit my stop, just hit it, and it would never have hit it if I hadn't moved it up. And then the trade went, that was that big NASDAQ move, went like 17 points. And he had quite a few trades this week where moving that stop to break even after first target hit cost us a full winner. And that's what happens when I step in and alter the automatic trade management strategy we have programmed. Next week, I'm not going to do that. That wound up costing us a lot of money because I did not want that trade to come back. But once it hits the first target on the NASDAQ, we've locked in profit, and I should not touch it. That's it. So that's what it is. I mean, I tried to outguess the market, and it was a big mistake. Sure, not a problem. It's not available on TradeStation. Patrick, it's not part of the platform, but sure, that's obviously also important. Yes, it does, Brian. The long-term Legear does change, and we're going to give you the settings for those. I mean, that's the only number that needs to be jiggled, and we'll tell you those. No, this market, Damien, is for every market. I mean, it's for the software that works on every stock, all the stocks, all the Forex, and all the futures. Now, the program's loading because the control panel is up, and the whole thing should be up very shortly. Okay, okay, Michael. Yes, we'll have a replay. Michael, we don't back test it, we forward test it. We do market replay data. And we did it on the NASDAQ, the E-mini, and crude for the futures. Sergio we did it on 3 Forex pairs. And for stocks, I'll be honest, we only did the Qs. We just forward tested it on the Qs. Remember, each one of those tests takes 3 days. So it's not like we can, blow it through. But if we back tested it, it'll be easier. But forward testing is more accurate. And Sergio has a program that actually can read winners and losers off of all that data. So that's how we do it. And those are the markets that we did. Only 1 stock. And we use the Qs as a proxy for stocks. There's not a pop-up alert yet, Randy, but we're going to program it in. The charts are coming up. I already have 1 chart that just popped up. I'm waiting for the others here. Okay, well, this is the only chart that we care about, I think. No, this is not the right chart. Let me make sure I've got the right, okay, let me just connect here. I don't know why I don't have futures up there. Let me open the futures workspace. Hang on one sec here. Futures. Okay, it's opening. All right, let me get to the rest of the questions. Yeah, they do change. Okay. We do all the setup for you, Gary. You don't have to do anything. Sergio will configure the whole system for you. No, it's not obsolete, Mercedes. We still use it. Thank you so much, Mercedes. Daniel, if you send me an email about that, I'll take care of that. Yeah, thank you so much, Eddie, my pal. Thank you. Yeah, we always give out 2 licenses, Roy, I'm sorry. If you want to trade it on 2 platforms, you can trade it on 2. We just always do that as a rule. I mean, most traders usually have a lot of traders have a desktop and a laptop. It's not a 50. The slope, it is changed to a 34. Does it give a 34 with the? You can do it. I mean, if you put the 34 in, John, it'll give you a 34 of a 34. We're building an automated system right now, Michael. I mean, you know, we're long overdue on it, but when our automated system is up and running, it should be killer. Because this is going to be the core of the automated. No, nothing's getting rid of. Yes, Michael. If it isn't multi-time frame, it doesn't have any forward-looking ability. And here we come. There come the charts. Okay. So we're reloaded here. Now let me bring this back over and we can look at, because the thing I want to do that's most important is, let me just quickly answer the question, and then I'll put up the different markets that everyone's asked for. DD, just send us an email. Yes. Jarnell, we're gonna have it next week. We'll set you up. Michael, those are tough. This is the number 2 trades are pullbacks. And those are trades that those are trades you're really going to have to find. It's tough to get it to create a number 2 arrow because you're going to get one on every retracement. So that's very, very hard to do. And I just don't know if we're going to be able to do that. And I don't want to mislead you and tell you it's in the works or anything like that. That's really hard. Now let me find the chart again. Here it is. I got it. No, I don't have it. Which one is it here? Hang on one second. I'm looking for my long term and I don't see it. All right. Hang on one sec. Every chart came up. I just have to find the right chart here. All right, I'm gonna have to make a new chart. I don't know why. Let me move this over, and it'll take 1 second because I have a template, and I can create it. Hold on 1 sec. And here's how you create a new chart. You just go to File, New, Chart. And we'll just start it as crude. 5210. Load it. And then just put in the template. Template, load. And it's the Legear multi-time frame order flow. So we have the chart back. Here we are. Now, the only thing I'm going to do is make the order flow line transparent again. To simplify it. And also put it into oh, it is the same as data series. No, it's not. Order flow. Let's put it into same as data series. Here we are. Okay, we're back and ready to go. Now, let me finish with the questions, and then I'm going to go look at all those markets that you want me to look at. I'll look at all the stocks that you want to see. Stop loss, it depends market, it depends on the instrument. The stop loss on the E-mini is 11, on crude it's 13, on gold it's 13, on the NASDAQ it's 25 ticks, but we're looking for a 7.5 point move. So it's a reversal candle essentially. And in terms of commodities, Mahesh, you can trade as many as you can watch. I mean, you can put up as many charts as you can handle. I mean, there's really no limit, actually. Any indice and any stock, Mahesh, any FX pair, and I'm going to show you FX pairs now. No, what we do, Michael, we set two targets. We set our first target and second target because we're able to tell how many got a first and how many got a second. So it gives us a little bit of a better handle on win percentage, but our key really is just that first target. If we get that first target out, we know we have a winner. If it hits our stop, we know we have a loser. And it's still impossible to define winning amount. I mean, it really is. I'm telling you, it's hard. And let me tell you one other reason too, Michael, is that when you do it at 500 speed, you pull in some slippage, and it's a little bit more of an elegant calculation than just standard. But we have a very, very good handle. I'm telling you, it's close to 80%. If we wanted to create a profit curve, I think that we could, but really our goal is to provide a winning percentage. And if it's really high, you're going to do really well. I mean, if you're going to make money on 8 out of 10 trades, you're going to do really good. You're right around there, Gann. About 2.5 to 3.5% of the ATR. That's correct. I think the automated is going to be ready in about a week and a half, Sean. We finally have all of the components ready. I'm doing the templates, Dale. If I was in a hospital bed, I'd be doing the templates. I'm doing all the 7s, all the 8s, and all the Forex templates on the weekend. I'm going to show it to you, Gord. I'm going to show you the Forex system. Okay, I'll show gold. I don't want to get so shoot too many, but I will. Okay, Robert, you got it. Well, I think we've got that, Michael. I mean, I think our targets and stops are right on. Now, if you trade stocks, we may have to do some calculations for you. But for Forex and futures, I think we already have those numbers. Now, you know, we have a recommended automatic trade management strategy, we program into your system when you come aboard. You can always tweak it, but it's our recommendation. And listen, it's really an area that very, very few companies even delve into. They give you the software and they let you find your stops, let you find your targets. They let you do all of that. We've really taken the burden on ourselves to provide you with what we hope to be the best. But you're welcome to modify it a little bit if you like, if you can find a better one. But I think ours are very good. The second target depends on your instrument, Gann. On the NASDAQ, it's 30 ticks. On crude, it's 15 ticks. On the E-mini, it's 3 points. On the Dow, it's 30 ticks. On Forex, it's 15 pips. So it really depends on what you're trading. Okay, Paul. For crude, first target is 7, second target is 15, stop is 13. The NASDAQ first target is 15, second target is 30, stop is 25. Now, if you go for a further target than that, I believe your likelihood of hitting it will significantly diminish. You know, everybody asks for that 1-to-1 risk to reward, but you're only going to get targets that the average true range is going to offer you. I mean, it'd be really nice for us to put a 45 tick for, second target on the NQ, and you'll hit it once in a while. The majority of the time, you're going to come back all the way on that trailer and give back a lot of money. So our targets are reasonable, and we hit the second target on the NQ a lot. My pleasure, Terry. Yes, the software for all the markets, Frank. Well, the 3-line indicator has order flow in it, but it also has stochastic in it. So we didn't want, so the Legear is a better momentum assessment than stochastic. So it kind of made the 3-line antiquated, Satish. So we modified the 3-line just to project order flow and let the multi-time frame Legear handle our momentum assessment. And it gives us much better entries. It's very soon, Sean. No, it's not back testing. Listen, Michael, it's not back testing. Back testing is you have a static chart and you simply scroll it back and you look at the entries. Forward testing is you actually start from time 0 and let the market evolve so that it's moving this way forward. And then you let the software evaluate the trade. It's a much, much more precise way of assessing how it's going to perform in a live market when the software is seeing price move across the right edge, as opposed to just, back testing is just flipping. And when you back test and you do it personally, you have your own personal discretion. Well, I might take that trade. I wouldn't take that trade. That trade's a little too close to a pivot. That one's not too far from a pivot. That's all eliminated when we forward test and program the parameters. So it's done objectively, and I think it's more accurate. Hey, God bless you too, Phil. Thank you so much. And Daddy Rory, he's fine. When you say negative, Damien, we try to get a 1-to-1 as best as we can. When we hit first target on NASDAQ and most instruments, we've got profit locked in. On a couple of instruments, we don't, because when you trade a leveraged instrument in futures, the volatility of the instrument won't allow it. Stocks always, you get a 4 to 5-to-1 risk to reward, easy. It's not leveraged. You can risk on this stock system. You can risk 11 cents to make a buck. You just can't do that with futures. It's just not possible. And if you want to be rational about your targets, believe me, I'd like to get a 1-to-1. But if you get a 0.8-to-1 and trade with 75% winners, you're going to make a lot of money. We do have a scanner, Randy. It's separate from this, though. Now, the replay link will be sent out. Now, let me go back and get some markets that traders ask me. Oh, thank you, Al. Thank you. Do you need to stop? I will tell Rory. I think Rory's watching. Do you need to stop? No. Okay. All right, Damien. Let me just show a few of the. Somebody asked me for gold, and let me put up gold. I know there are others. I'll get to them one at a time. And I'm going to put up the Forex, so don't worry about it. Now here's gold. And here's one winner right here. It's the break of the pivot on green. It's a number 2 trade. Actually, well, you know, it's a continuation of a number 1. This is a trade where you might have taken the entry here, where there might have been enough space to the pivot. It's discretionary here. You could have entered here or on the pivot breaker here. That would have been a number 2, and you've got a winner here, or you've got a bigger winner here on gold. Here you have nothing. In fact, no, I take it back. If you look at the pivot breaker here, here's where you just have to look at the slope of momentum on your trading chart. It's stoking up. So you've got momentum on your trading chart. You've got the long-term momentum with you. And here's another winner. Here, you have nothing. When you have this line yellow like this, you just step aside. And if you want to see chop, here's chop right here. There's nothing to trade here. Now you do wind up with a nice trade, but that's the price you pay for not really being able to trade that, make that trade. But this is a good example of chop defined right here. There's really no great entry to take here. So you've got this winner, and you've got this winner. No, you don't. You don't have the long term. Now, see, here's where you kill it, right here. Red. Well, you can't take that. You don't have the 3 line. You have to wait here. You see how the 3 line here censors this trade? The 3 line order flow is up. No trade. Here you can't take the first candle, but you can certainly take the second. And down you go. The continuation trade here, down you go. Those are huge trades on crude. Now they're early in the morning. Here you go. Now, see, now you have no long term. You have no trade. No long term. So you're just flashing. You have no trade. And here's your trade. Up. Now here, you're censored, the number 1, because the 3 line isn't with you. It's magenta. It saves you, and you see how right here, your trading chart's red, momentum, the 3 line's not with you, and any thought of taking that trade long is history. Okay, let me add a few more days in here. I'm just going to add 5 days. I had 10 days in the last one. So that's it for gold. I'm not going to do too much on these other instruments because I got so many. But you can see that it's very precise. And when you get a pullback into a green, you've got yourself a nice trade. If you've got the arrow and green long term, you've got yourself another nice trade. Both the 1 and 2s work really well. Hang on 1 second, Mark. No, that's not the same one, Mark. Not the same one. Now, somebody wanted to see Google, and let me put up Google. Let me show Boeing first. Only this time, I'm going to put Boeing up on only 5 days of data, and I'm going to use a let me use an 8 Renko. So this would be 80. This would be 16, and this would be 40. That's going to be easy to do this one, and then we'll put up Boeing. Now here's Boeing really quick. Let's take a look. Now, Boeing is pretty choppy. You see the long-term Legear is not giving us an entry. And the 3 line is not aligning either very well. Let's keep looking. So here's an entry right here on the long term, red. Here's an entry here on a number 2, pull back green, green. These are both into pivots. Now I don't know. Here's the pivot breaker right here. And this actually comes down to a green long term, I believe. But I don't think you have the Legear. I'm not going to even count that. See, Boeing is a much tougher assessment. Let's keep looking. So here we go. Here you don't have the 3 line at all. Here's a trade. It's not a huge one, but it's not bad. Let's keep looking. Now remember, this is a day trading speed. It's not a swing trading speed. Now here's your chart. Here's a nice trade. There's your arrow. The long term is red right here. Now you have the pivot. You've got a little bit of distance. The safer trade is around the pivot right here and down. Now the risk to reward here is incredibly good. Your risk here is 96 ticks, 96 cents. And if you took the trade here, you make $2.38. I mean, that's 2 to 1. If you took the trade here, you made at least 1 to 1, much more than 1 to 1. So right here, this continuation is censored by the 3 line. It would have been a tiny trade. This trade here, censored by the 3 line. You see how it's protecting? Here is a trade. Now, it's a tough one because you need the momentum on your trading chart heading down, but it's tradable. And that's a winner. $1.22. And here's a beaut. And this is the last one I'll show. Right here. Now, I'm just scaling these to the first reversal candle. Right here. $1.31. So you've made over 1 to 1 on every single trade. 2.8, 2.3 to 1. So you're going to get really good entries. And you see how many bad trades were censored. You have an up 3 line on this down move. Up 3 line on this down move. I mean, they kept you out of a lot of problems. And they really do protect you. And here's your stellar trade right here. Here's your day maker. You can get in here right here. Um, it's a number 2 because you don't have the arrow. But look at that trade. I mean, it's a hand me trade right off the 50. That's a $4.20 trade on 98 cents of risk. I mean, that's a killer trade. And you've got green. So that's Boeing. That's about correct, Leon. It needs. You're about right. No. Yes. You know what, Paul? I don't even know. You know what? The way Sergio, I'm going to sit with Sergio. Hold on one second. Let me look at Michael. Listen, Michael. You may be completely right. Michael's saying that the difference between forward testing and back testing is the same, and he may be right. Michael. It's just the way we do it. I mean, it's just the way we've done it since we started the company. I mean, and you may be completely right. So let's look at Google. Hang on one second. Now I have to put Google into my instrument manager, and then after that, I'm going to go to Forex. Hang on one second here. Let me find my. Okay, let's rotate to Google. Came up pretty quick, and this actually might be too slow. A 40-unit Renko. I'm not. Let me take it down a little bit. Google doesn't have quite the volatility I thought it would have. Let's take this to a 160. 30. And an 80. Here we go. Oh, here's one move right here. It's perfect. There's your long term. There's your trading chart outlined in blue. And up you go. And I mean, out of curiosity, I want to see how far that trade went. $5.21. Now here's another trade. You really can't take this trade because it's into the 50 and the 15's above the 50. So by our trading rules, this is just not an entry. And I don't want to just stick an arrow there and give you a winner because it's not. We wouldn't trade it. Now here's how well the pivot works. Every single short trade into this pivot, stop. There's no up, down into the pivot, up, down into the pivot, up, down to the pivot, and unfortunately, the breaker is on order flow in the wrong direction, so you can't trade it. But look how many losers it saves you from taking, potential losers, by not trading into this pivot. And because this pivot is set at a candle body low, The wick low could be down here, and you could take all these trades and lose. You don't have anything here. And here's another winner right here. Here you got enormous room. And this is about a $4 or $5 move. Here's a number two. Here's your number two. The pullback, whoops, and the continuation. Right there. Now here, you don't have the long term to take this trade. It's yellow. Well, this is going to give you a smaller move, but you can't take this either. The 15's below the 50. I'm looking for a trade. So you can't take the short trade because the 15's above the 50. We need the 15 below the 50 or the 15 above the 50. And right here, I don't think you get it. You don't have this. So you don't, no dice. Now here's a winner, but it's way up. You've missed a lot of the move, unfortunately, but it does make money for you. Now this is a really small move. I doubt that made any money for you. Here, you don't have the long term. So that censors that trade. Here, you do have the long term. So this might be a loser. It's the first loser we've seen. Here's the pullback. See the wick outside the candle? That's all you need. And there's another winner. Now, since the risk to reward here is way in the direction of the trade, you're going to take out this loser in just a piece of one winner. If we average a loser as $1, this winner is $2.89. So right here, this is almost a 3-to-1. So let me now move the market to the Forex. Let me disconnect, and I'll show you some Forex pairs. Disconnect. Let me bring up the control panel. Change the workspace to Forex. All right, it's opening. Give it a second. Here it is. Boom, 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 boom. Now let me connect the Forex data feed. All right, so it's connecting. Mark, I'm gonna try. Randy, I'm gonna make a really nice video tutorial over the weekend on the system. It'll tell you everything you need to know. Now I'm gonna drop all these Forex pairs, and I'm gonna recreate the template, and I'll put up, I'll put up. I know somebody asked me for a specific Forex market. Now in the Forex, we use this scanner, which gives us this alert when we're flashing a trade. And let me drop all these markets. And drop this, this, and this. And let me just create a new template. And this is going to be off of Forex, a new chart. And I'm going to bring down. I'll just start with the pound dollar. And let me put the template in. And I'll show you any Forex pair that you'd like. Okay, here we go. Now this is the pound dollar. Now, I'm sorry, I gotta do the same thing, I'm sorry. On the order flow, let me make this transparent and move this into same as input series to make the chart easier to assess. We don't need that line at all. Here we go. All right. Now let's take a look. And one thing I want to do here is on the okay. That's our Forex setting. Now, on the Forex setting right here, this is early in the morning, but move up, move up. You'll notice here, I mean, there's a potential for a move up, but look at the long term and look at the chart. They're both telling you to be really be more on the hunt for a short trade. And here's your short trade right here. Look at the candle halo. It's blue, no trade. Look at your short trade here. Candle halo, blue, no short trade. Even though both Legears give you permission to take a continuation short here and a continuation short here, no way. No, you have to take it on the pullback. This is one you cannot slide across, Damien. You have to take a pullback candle. You just can't take the next one. You can slide on a pivot breaker or on one candle right off the 50, but you're not going to go in on this one. I mean, those are a little bit more. Those are a little bit more of the nuance, and I'm not making that up. I mean, you're not going to. How would you know if the conditions are met? Here's the thing: if the trade has matured, any additional room off the 50, you want to take the pullback candle, and let me explain to you why. Okay, when you have a pullback candle, you have to use both. You have to use both cross. I don't want to make this too complicated, but here's the thing: when you get a pullback candle, remember what we've talked about? We want to run over traders on every single move. Well, here's what happens on this pullback candle. We know that buyers have tried to reverse the market and they failed. And the market continues down, but we can't take it because order flow prohibits us from doing it. We want to make sure that we have buyers in the game on the candle we take. We have no buyers here who have appreciably pushed the market up. It's the same thing here. We have buyers here who have tried to reverse the market. They fail. Here's the continuation trade. But order flow is telling us that there's buying pressure. And remember I said that order flow is a leading indicator. It comes in before the turn. Well, here's where it comes in before the turn. So if the trade is right at the 50, and let me try to give you a good example. But one thing you're going to see is every entry, Damien, comes with a wick. It's got to have a wick or be leveraged off a reversal candle. We need to trap buyers in the opposite direction to guarantee we're going to get a continuation. If that entry does not work, we can't take it. Now, let me show you why the only reason we can take a pivot breaker past a signal. Now, see, here's an entry right here. We just don't have the long term. And we don't care if there's a winner we can't get. As long as there's as long as we can sidestep the losers, that's all that matters. And look at this trade down here and look at the long-term Legear. No way. Trade down here. No way. I mean, it holds up every loser you see here. And the Forex can be choppy. Now, the reason we can trade, let me find a nice pivot breaker. Right here. Here's the entry. Why? No, this we really can't take anyway. But let's just forget about this, because here's the principle that I want to make clear. Why do we not need a wick on a pivot breaker? And why, if we get a candle arrow here, can we still take the pivot breaker? Because the pivot breaker takes out all the buyers in the pivot. So we are leveraging traders caught in the wrong direction on the pivot breaker. They're stuck here. And I'm telling you, everybody in the room and myself have seen pivot breakers blow down really fast. So the pivot breaker is the exception, because on the break of the pivot, you are blowing the traders out who are in the pivot. Otherwise, the only entry you can take is this one. And if that doesn't set up, there's the wick, that's the number 2. And if you don't have green under the pullback for the continuation trade with the 3 line, you have no entry. Here's your short with the 3 line and the entry. Look at the continuation here. Blue, no entry. Another loser, gone. Blue, another loser, gone. Censored. Here, that's not a great trade, because look at the Legear. I don't see any great slope on it. And let's not take marginal trades. Now here, we're trading right up into the pivot. Up, back. Up, back. Whoops. So you see why we never trade into pivots. These are really good pivots. The pivot censor the trades, the 3 line or order flow censors the trade, and you see how few losers you can take. This whole move has order flow in the wrong direction, but that's okay. It doesn't make any difference. Now here we don't get a pullback. So we can't take this move down. We just can't jump into the trade, because we have no guarantee it's going to continue. Let me see. Yeah, I mean, listen, it's just a little bit of screen time. Here's your long entry and your winner. Right here, you have no trade. You don't have the long term. Here's your trade. No 3 line. Censored. Can't take it. Doesn't matter if you have to sidestep a winner, as long as when you take a trade, it has a high likelihood of winning, and you saw all the losers we sidestepped. You sidestepped a million of them. And here's your winner. There's the pullback, and there's the continuation. And it goes right where you would expect it to go. You take everything out right here. Even if it hadn't hit your second or third target, you are exiting. And look at the 3 line. Your last candle is an up halo on a down candle, right at a pivot. If that doesn't tell you that the market's going up, I don't know what does. But we don't counter trend trade. This one again is an trade because I don't like the slope of the Legear on our trading chart. I'd rather let a winner go than move into a high risk trade. And here's your bread and butter trade. Look at the size of that trade. And I'm telling you, I could do this all day on any Forex pair. If the trade like this is kind of marginal slope on your chart, just leave it be. And when you get a trade like this, well, you don't have the long term. You can't take it. But this is a trade. And I'm telling you, these work very, very high percentage of the time. It just a number 2 requires a pullback candle on the entry, or it's off of an up candle and then you get a continuation trade. And here it is again. There's the up candle and the continuation, all the way, right there. Okay. So I mean, this was supposed to be an hour lecture. It's 2.5 hours, but I want to show you how it works in a market, and I wanted to show you how the 3 line and the pivots censor tons of losers. Because as important as it is to get a winner, it's just as important that the system sidesteps the losers. And you saw the 3 line sidestep multiple losers. And it's going to do that. And that's the power of the system. You want both Legears in your direction, and you want order flow. They're all multi-time frame assessments except for the Legear on your trading chart, which you need in your direction as well. So, and I wanted to make that an independent assessment because it doesn't have to be locked long. It can just be sloping up, and you're good enough. Good enough. I mean, if you popped a wick on any of these trades because the Legear slope is up, well, you need your long-term green. But I think everyone's got the idea. These are simple trades. Number 1 on the arrow, which is going to come right off, down off the 80, up off the 20, or a pullback into dual red or dual green with the order flow line, with order flow in your direction. That's it. Very simple. No problem, Damien, at all. So that's it. Again, here's the offer. You'll come in, you'll trade with me in the room. That's the core part of our system. We don't trade without dual Legear. We don't trade without order flow. And the pivots are for the first 10. There were 225 people in the room. I mean, it was one of the biggest amounts of people I've ever had attend this. So everyone have a really, really wonderful weekend. And we will send out a video. It's going to take a while to render, but it'll go out today. And everyone whatever you do, I just wish you the best of luck. I saw a lot of people in the room from my trading room, and hi guys. And I hope you learned something more from this. So take care, and I hope, even if you don't come aboard, that you learned a little bit more about trading, what's needed in order to get a leading indicator, just about the principles of trading, things like that. Hey, you too, John. Thank you much. So everyone have a really, really great. Thank you so much. Everyone have a great, great weekend. Bye-bye. Thank you, Al.